Here's a number worth sitting with for a second. $467,000. That's not a life-changing fortune. In many US cities, it's less than the cost of a median-priced home. And yet, according to the math we're going to walk through today, $467,000 split equally across 4 specific ETFs could realistically generate around $5,000 every single month without selling a single share. Most income strategies at that scale involve owning rental property, locking money into annuities, or building a bond ladder that barely keeps up with inflation. These 4 ETFs do none of that. They're liquid, publicly traded, and pay monthly. So if that sounds worth understanding, stick with me. Today, we're breaking down the 4 Horsemen portfolio, originally put together by Michael Brownstein from My Retirement Trading. 4 ETFs, 1 clear strategy, 1 clear goal, serious monthly income that doesn't require you to cannibalize your own principal to get it. The tickers are GPIQ, QQQI, TDAQ, and OVL. By the end of this, you'll understand exactly how each one works, what they cost, and how the math actually plays out at different investment levels. Let's get into it. Quick note before we start, this is educational content only. It's not personalized financial advice. Past performance doesn't guarantee future results. Always do your own research and consider talking with a qualified financial professional before making any investment decision. The problem. Here's what most traditional income planning looks like. You build up a portfolio, you follow the 4% rule, withdraw 4% per year, and hope the money lasts 30 years. On a $1 million portfolio, that's $40,000 per year, about $3,300 per month. For a lot of people, that's not enough, and there's a deeper problem. The 4% rule works by drawing down your principal. Every withdrawal slightly erodes the base. If markets cooperate, you're fine. If they don't for a few years at the wrong time, it gets complicated fast. The 4 Horsemen approach operates on a different principle entirely. Instead of selling shares to generate income, you collect distributed income directly from the ETFs themselves. Your principal stays intact. Your growth potential stays intact. You're living off the harvest, not cutting down the tree. ETF number 1, GPIQ. The first ETF is GPIQ, the Goldman Sachs Nasdaq 100 Premium Income ETF. It launched in October 2023, and the strategy behind it is worth understanding clearly. GPIQ tracks the Nasdaq 100, but runs a dynamic covered call overlay on top of it. Goldman's team sells call options on a portion of the portfolio, anywhere from 25% to 75%, depending on market conditions. When tech stocks are trending strongly, they pull back on the calls to let more upside flow through. When momentum slows and the market is ranging, they sell more premium to maximize income. The result is a distribution yield currently around 9.8%, with a 1-year total return of approximately 23.6%. The expense ratio is 0.35%, which works out to about $35 per year for every $10,000 invested, reasonable for an actively managed option strategy. GPIQ isn't the highest yielder on this list, but it's the one that does the best job balancing income with meaningful price appreciation. If you want to generate income without completely capping your upside, this is the most balanced of the 4. ETF number 2, QQQI. The NEOS Nasdaq 100 High Income ETF. This one's become a real flagship in the income ETF space. QQQI also tracks the Nasdaq 100, but there's a specific structural detail that matters. NEOS writes its options on the NDX index itself, rather than on individual stocks. That qualifies them as Section 1256 contracts under US tax law, which means gains are taxed 60% as long-term and 40% as short-term, regardless of how long you've held the ETF. In a taxable account, that's a genuine advantage over comparable covered call funds. On top of that, the majority of QQQI's distributions have historically been classified as return of capital, which further defers taxes until you eventually sell. The distribution yield sits around 13.8 to 14% trailing, and the fund has crossed $13.1 billion in assets under management, which tells you this is very much a mainstream product at this point, not a niche experiment. It won Best New Active ETF at the 2025 ETF.com Awards. The one-year total return is approximately 20%. Here's the honest trade-off though. QQQI doesn't capture all of the NASDAQ 100's upside. In a strong year for tech, the gap between QQQI and holding QQQ outright can be 6 to 7 percentage points because you're selling some of that ceiling to generate the income. That's not a flaw, that's the deal. You need to decide which side of that trade-off works for your situation. ETF3 TDAC, the TAP Alpha Innovation 100 Growth and Daily Income ETF, is the newest addition here, having launched in September 2025. And it does something the other two NASDAQ ETFs don't. TDAC uses 0 days to expiration options. Instead of selling monthly covered calls, it sells call options daily, options that expire the same day they're written. Every morning, a new set of premiums is collected. Every evening, those positions expire worthless or at value. The strategy resets constantly. The result is the highest distribution yield on this list, currently around 17.4%. The YTD total return sits at approximately 12%. The expense ratio is 0.83%, which is the highest of the four, about $83 per year per $10,000 invested. That's meaningful, and it's worth comparing against what you're getting in return. Given that TDAC is also the newest fund, it has the least track record of the group. If you're sizing this into a portfolio, that youth is worth factoring in alongside the yield. The fourth ETF is OVL, the Overlay Shares Large Cap Equity ETF. This is what shifts the portfolio's axis. While the first three are NASDAQ 100 focused, OVL anchors in the S&P 500 and does it with a structurally different options approach. OVL holds 100% of its portfolio in VOO, the S&P 500 ETF, and then layers on a put spread credit strategy on the SPX index. Rather than selling calls, Liquid Strategies is selling puts, collecting premium for taking on the obligation to buy the market at lower prices if it falls sharply. The current distribution yield is approximately 10.3%, paid monthly. The one-year total return is around 23.2%, and since inception in 2019, OVL has actually outperformed the S&P 500 on total return in most measured periods, a genuinely unusual outcome for a derivative overlay fund. One moment worth knowing, in 2022, when the S&P 500 dropped roughly 18%, OVL fell further, around 22%. The put spread strategy provided some buffer, but not full protection. OVL is not a defensive hedge, it's a return enhancer with mild downside mitigation. It still moves with the broader market. The expense ratio is 0.79%, about $79 per year per $10,000. Now let's look at what this portfolio actually requires. The four ETFs, GPIQ at 9.8%, QQQI at 13.9%, TDAC at 17.4%, and OVL at 10.3%, blend to a combined average distribution yield of approximately 12.85%. To generate $5,000 per month, you need $60,000 per year in distributions. At a 12.85% blended yield, that requires approximately $467,000 invested equally across the four, about $116,750 per ETF. Here's how the annual income breaks down. GPIQ at 9.8% generates approximately $11,440 per year. QQQI at 13.9% generates approximately $16,228 per year. TDAC at 17.4% generates approximately $20,315 per year. And OVL at 10.3% generates approximately $12,025 per year. Total, roughly $60,008 per year, or just over $5,000 per month. And if you're not starting near $467,000, $50,000 invested, approximately $535 per month. $100,000, approximately $1,071 per month. $250,000, approximately $2,677 per month. $750,000, approximately $8,031 per month. If you want to think about how to act on any of this, start with allocation sizing. Many investors use a core satellite approach, a large core in growth-focused holdings like VOO or QQQ, with a dedicated sleeve for income-generating ETFs like these. Deciding what percentage of your overall portfolio you're comfortable putting here is the first real decision. Think about tax location. QQQI's Section 1256 treatment makes it relatively efficient in a taxable account. TDAX and OVL's return of capital classifications also carry tax advantages worth exploring. If you're holding these inside an IRA, the tax structure matters less, but still worth knowing. Watch the expense ratios over time. The gap between 0.35% and 0.83% might look small on a single year's return, but across a 15 or 20-year holding period, it compounds into real money. Higher costs need to be justified by meaningfully better outcomes. And a useful research tool for comparing these ETFs side by side, yields, price return, total return, holdings, is stockanalysis.com. Great way to track these over time as the data updates. Here's what actually sticks about the Four Horsemen portfolio when you look at it clearly. It's not designed to beat the NASDAQ 100 on price appreciation. It's not optimizing for the best possible 10-year return chart. It's solving a different problem. How do you generate meaningful, recurring monthly income from a portfolio without slowly spending it down? 4 ETFs, 3 different option strategies, 2 different indexes, 1 blended yield around 12.85%, and approximately $467,000 to reach $5,000